Hey everyone, 23. Welcome to TechTO Quick Takes. I'm your host, Alex Reilly, and here are today's headlines. Our paper, Vendasta and Point Click Care, the new consolidators in the Canadian tech ecosystem, we'll discuss. And the travel industry continues to rebound with this latest piece of Ray's news. Canada drives pandemic pivot, ends up in the ditch. And for our lightning round, we'll go through a few notable raises and acquisitions that are making news from the last couple of weeks. And to help me break it down, Alex Norman joins me. Hey.
Hey Alex, did you know it's spring?
Yes, the rain is kind of a good reminder of that.
Well, I think spring, you think flowers blooming.
Yeah.
It's starting to get a bit busier in news again. So
Yes.
not all positive, and we try to focus on the positive. The only time we go into negative is when there's something to be understood. But there's news happening, and I think we're going to start seeing more action and activity in the ecosystem. Hopefully, less
Absolutely.
bank runs and more interesting tech news.
Yeah, and I'm glad you pointed that out because obviously we don't love talking about anything negative, but of course, if there's a learning or a good takeaway, we obviously want to bring attention to that so folks in the community can learn something. So, as you said, lots to talk about. Um, I'm interested for this first story just because there is a combination of three different companies that we are highlighting what is similar about all of this news, which I think is a unique perspective to have. So before we do that, why don't you start with just the news as a whole and what these announcements were for each one of these companies?
Okay, and sometimes, Jason, or you might accuse me of trying to just lump news in there so we can cover more. But I think
No, never.
when I see some patterns, I think we have to call them out because one piece of news is not a pattern, two pieces of news not, but three, okay, you got something interesting going on. So
Pretty unique,
yeah,
yes. Yeah.
and I don't think this is going to be unique. Actually, we'll get into that. Look, a trio of acquisitions were announced over the past 2 weeks by three different large private Canadian tech companies. In particular, as reported by BetaKit, Saskatoon-based Vendasta announced that they were acquiring San Francisco-based Broadly. This was Vendasta's fourth acquisition in the past 2 years. Then you had Toronto-based Point Click Care announced their acquisition of Patient Pattern. This is Point Click Care's fourth acquisition since 2019. The Montreal-based Vancouver announced its second acquisition in a month, which was a company called Reilly, which is reading software.
So now, as I said, I don't think you're lumping these together. I do think there are many similarities that we want to talk about with these, all of these deals. So why don't we get into what the similarities are?
Yeah, so similarities are a few things. First, the acquirers are well-funded private companies with large revenues looking for growth. Two of them are, one of them is purely VC-backed. I'd argue that that's being paper. Vendasta somewhere between VC and private equity, or because last round I think it was done by a hedge fund and we're looking going public. And Point Click Care is private equity backed. All three of them, a lot of cash, a lot of revenue, and they want to continue growing. The other thing that they all have in common is not for all these companies, it's not their first acquisition. So it looks like growth through acquisition to fuel non-organic growth is part of their strategy going forward. Then the companies acquired were all acquired to grow by increasing the product suite. So the idea here is you buy these companies, you have more products to sell your current customers. With the one exception here, maybe being Vendasta, who actually said, "Hey, Broadly has a bunch of customers we can sell our products to, but we're also going to sell Broadly to our customers." So you're looking at companies private looking to buy and grow, and they're buying products to sell to their people. The other thing, all three companies that were acquired were venture backed.
Yep.
And the other thing, which I always say, when you don't see a price is not leaked. That means acquisition is probably not that lucrative or that high value. But none of them had price deals announced part of the announcements.
Right. So, I mean, why is this happening? Obviously, a reflection of like the changes that have been happening in the funding environment. But why? I mean, you can get into that too. But why is this happening? And is this a good maybe reflection of things being accelerated for the rest of the year or maybe into next year?
If you were to ask me last summer, we see this pattern emerging, we'll get to what this pattern is and what's happening. I would have thought it would have happened earlier. So
okay.
I think we're going to see more acquisitions like this throughout the year, and it'll probably accelerate the later we get and the longer the stock market and the funding markets are down. So what's happening here? So none of the three acquiring, all three, let's start with acquirers here. Let's start with who sold. They were all venture backed. what they seemed to all have, and they were venture backed, and the acquisitions pointed out the products they had. So that means all three companies probably had a good product, some traction with validation that there's customers willing to pay for it. But they probably went to market, they probably needed capital, and they could not raise or could not raise in attractive terms. So the best outcome for probably the founders, the employees, the past investors was an acquisition by strategic buyer who, because all these buyers value their product, can have distribution to sell it, so they can pay more than someone that wasn't strategic. So they, my guess is lots of these deals were based on the value of the product, may have had some earn out. Don't know if they did, don't know if they didn't. And it provided an outcome for these venture-backed companies that were probably had only months of runway. So there was as I said, the prices weren't announced, so there was probably some price paid that wasn't a venture-scaled outcome, but it's better getting some money than shutting down a company. Then let's look at who the acquirers are. They're in a position of strength, as they have money, they have revenue, and the key thing here is they're not publicly traded. If we go back 18, 24 months ago, these would probably we'd be talking about Shopify or Lightspeed, companies that had a public stock and a currency that they could purchase. But what's happened over the last 12 months, as we know, is all those companies have had their share price decline significantly. And they now have pressure on to show more cash flow positive, better economics. So there's a lot of pressure on the public companies who are now have a currency not as valuable as they did before to improve their numbers and make their shareholders happy. So what this allows these private companies that are large to be more aggressive with their acquisitions. They probably have shareholders that they can talk to the strategy, and they have a currency that hasn't been devalued as much. Maybe, they say, hey, here's what we last raised money at, and we're going to buy you with these shares, or we're going to raise more money at a similar valuation. So they have now more valuable currency than the public companies, and they're aligned with their shareholders that they don't have to worry about the short-term margins. We're buying this to grow revenues in 18, 24, 36 months when we think about going public or our next round. So it's in a weird way they were stronger than before. The other thing is the fact that all three of these companies have done multiple acquisitions means they're most likely building, a team to do acquisitions and another team to do integrations that will give them a strength that gives them more confidence to do more acquisitions going forward.
And so for this question, probably a few reasons to just tack on to your response to this. Why is this different than what we were seeing a year ago? Like I said, I'm sure there's a few, so just maybe go through those.
Well, first, like I mentioned before, we were talking about acquisitions and growth through acquisition 15 months ago. Those companies were public. The fact is now we're talking about private companies doing it. So it's interesting to see how the reactions to the funding market has changed who can buy. I think the other thing is, there was also, we talk about the consolidators that were backed by venture companies. So these were the companies like Thrasio, raised a bunch of money. We're going to consolidate the Amazon sellers. Their model is based upon high leverage. So we raise $1 of equity, you can get $10 to $15 of debt, and low interest rates and multiple arbitrage. Those players are also facing harder times right now because debt's more expensive and debt's harder to get. So the multiple of debt to equity is lower. The cost of financing it's higher. So the two big people we were talking about, or two big groups of acquirers we were talking about 12, 15 months ago, are less acquisitive and have to be much more strategic about those acquisitions. And now you've got these companies that are private, large scale, have a good currency, and now being consolidating. So we've seen sort of a passing of the baton. I'm not saying we're not going to see like Shopify make an acquisition, or we're not going to see Thrasio type companies make an acquisition, but there's going to be much more of these large private tech companies that are good footing being in a position to grow through acquisition. And then I think the other thing that's happening here, and why I think you'll see more of these, sellers have fewer buyers and less options for financing than they did before. So that means the valuations of exits will be lower. The exits will probably come faster, as when you could shop around, get more people at the table, you could find a way to stretch it out. When there's more people, when funding was an option, you had a few options of what to go forward. But I think there's a lot of companies that built something good and they just haven't reached the takeoff velocity they need, that now have to go find owners for the products and to protect the legacy of what they've built.
And I mean, we've gone through a lot, but just lastly, some final takeaways for the community and things that they can, take with them going forward.
I think the number of acquisitions will increase over the next 18 months.
Okay.
Um, you will see a few of these companies build a strength in growth via acquisition, like I talked about. Historically, Cisco, which, if you look at the first dot-com boom, became the most viable company in the world, and it did that via acquisitions. It was a strength. So I think if you're a company that's looking to sell,
Mm-hmm.
you now need to look at a larger group of potential acquirers and build those relationships sooner and understand the model and look. And I'd actually be looking for a company that's made us a strength, even though you might get a lower valuation. If you have to stay with the company after, if someone has a company that a group that does acquisitions, a group that does integrations, you'll have a much more successful transition because going to acquire is always a difficult path for a career, but there might be some companies that have strength and you might want to favor those. Going to reiterate here what I've seen for a while. Funding for post-seed companies will
Mm-hmm.
be more selective, and companies that need to prove they have product market fit. So I think it's no longer good enough to show some traction. You have to raise that A round. You have to show you have product market fit. This was not the
Right.
case before.
Yeah.
Um, the other thing is talent will become more available. The talent will have experience. The talent that comes from these companies will experience some growth, maybe not be, traditionally successful, but this talent will be help lots of pre-seed companies and seed companies grow faster. And I think this is a net positive for ecosystem,
Mm-hmm.
as companies that are sort of the worst thing to happen to a founder and a team is to be sort of successful for 6 years and not go anywhere. What you
Right.
want is either a quick death or a great success. And I think if you have some, I think this was going to shake out a lot of companies that probably in 3-4 years, if they hadn't, strike lightning, would just have, been 3-4 more years building something that wasn't successful. Now we're going to get these great talents back at other companies and have quicker iterations to build those massive companies for the ecosystem.
Right. And I think that's an interesting highlight too, because stagnancy is, or to be stagnant rather, is probably the death to a lot of companies. And also, I know talent, for example, doesn't want to join organizations that maybe aren't progressing or growing in that sense either. So, product market fit and being stagnant, obviously, two good things to call out. I also like that this headline is related to two companies that we've had join various TechTO activations and events that we've had. Point Click Care did a podcast with us, and I believe Paper did also,
Yeah.
and spoke at an event. So I will make sure that I'm just linking that relevant content in our newsletter. And if you would like to see those stories, for example, and also just catch up on anything you might have missed today, you can subscribe to our newsletter at techto.org/newsletter. We've been doing lots of great things with the newsletter. Anything you
Uh,
want to highlight?
Well, a couple things. We're working on more founders FAQs.
Mhm.
The first couple were really well received. We're working on other new recurring feature, which we hope to produce soon, which will give you another way to look at the ecosystem and find opportunity people to work with. And finally, we're starting to prepare next year's rocket ship list. So look out
Yes.
for all that news in our newsletter.
Yes, and I believe one of the topics we want to cover is just like how to go about finding a co-founder. So we've done a call to action for people to make suggestions. If you do have suggestions, feel free to leave a comment, reach out to us, and let us know how you think someone should find their partner in business. So next story to get to is travel industry continues to rebound just with this latest news from Operto. So why don't we get into what that news is and then also what they do?
So Aperto, which is Vancouver-based, announced a 25 million USD round led by Santana Growth Partners. Aperto basically enables travel property owners, think of hotels or Airbnbs, to automate their properties. So what does this mean? It allows these properties to remotely control stuff like opening the door, monitoring the properties, and while giving the guests a better experience. So what this leads to a better customer experience and reduces operating costs for the property owners. So think of the product as like, you want to do guest, you get to a hotel and you don't have to go to the front desk. You automatically get a digital key. You can open your door.
Yep.
Maybe if you want to order some room service, it can be done all via phone. So it's digitizing and improving the experience for guests while reducing the work needed for these property owners.
Kind of reminds me of like a Sonder where there's not really a necessarily like concierge that's there. You kind of just have all the information you need on your phone and just can kind of check in and like come and go as you please. So I also love to see that the travel industry is rebounding. I know we all miss travel, so this is again really positive that we're talking about this. Why else is this company notable?
So first of all, it's been flying under the radar in Vancouver, and the last two rounds, this round and the previous one, were led by American investors. So I always find it interesting when there's companies succeeding and the Canadian ecosystem hasn't embraced them yet. It's second of all, it's benefiting from the post-COVID travel world. So what does that world look like? Customers want a digital first experience. They don't want to go to the front desk to check in. They don't want to have to interact with people. So this is
Mhm.
enabling,
Yep.
digitizing a physical experience. The travel industry is short staffed. They had layoffs. Then people wanted to go back, during COVID, and people wanted to come work with them, get them back to work, and people didn't want to go back to work in the industry. And it's there, so there's less people available for a post COVID travel boom. And then you have also the overall this thing called inflation you may have heard about. It's putting pressure on property
Yes.
owners' bottom lines. So they're also looking for operating efficiencies. So basically, all three trends feed into what Aperto's doing. And like the companies that we just talked about in the last section, Aperto has acquired several companies to grow its product
Mhm.
line and customer base. So even though it's not a household name and it hasn't raised
Right.
a ton of money, they've already used this growth strategy to let's get some additional products that are being built, but we have distribution for.
I like that you highlighted that little tiny thing called inflation that people may or may not be aware about.
Never heard of it till
Oh,
today.
right? Never heard
Yeah.
of it either. Who even knows what it is? And just lastly, just some additional takeaways for our community.
Look, you know, people talk about it, but I don't think we give enough credit to timing. Uh, Timing is so important in life, and especially when you build a startup. You
Hmm.
can do everything right, but if headwinds exist, then it's just more difficult to succeed. You may get some with a bigger moat, but it's always easier to have tailwinds at your back. You like when you're going taking the traveling analogy, when you have tailwinds in the plane, you get arrive at your destination faster. It's like that here. And right now, travel tech is the perfect example of this. In 2020, the industry ground to a halt, and many travel tech startups died.
Hmm.
Then there was less demand, no one had money to spend, and then start as soon as the world started opening up, travel not only did travel take off, travel had what they call it, the pandemic revenge travel. People were traveling more
Yeah.
than ever,
Yep.
but the industry had changed. As I said, less people, less experienced, people in the industry. Consumers had different digital experiences. Inflation was putting costs on here. So all of a sudden, if you're a travel tech company that survived or someone entering the market, you had an industry that not only had tons of extra revenue coming in, but wanted to change the way they're doing business. So a lot of reason that there's demand for products that are changing their business. And likewise, while funding is difficult right now, I think if you have a bit of traction with travel, you can answer the why now. And the venture capitalists are looking at investing in this. So it's a bit easier to raise money than you expect. And, for the non-founders out there, if you're looking for a new role, you may want to reach out to some of these quickly growing travel startups
Mhm.
because you can be getting on a rocket ship.
I also like that you kind of highlighted that the process for everyone, just the recovery after COVID in the travel industry was, I mean, it was surprising and it was different. The revenge travel aspect, but also a lot of these travel companies were lacking staff to accommodate for all these people that were traveling too. So it's just interesting to see the pivot and the recovery happen in
So,
real.
Alex, I have a question for you. What
Sure.
what destination haven't you made that you wanted, you've been dying to since like COVID started to? Is there a special destination you'd like to travel to?
You know what? I think on my bucket list is I would love to do a safari, an African safari. I think that's been like my family's plan for a really long time. And that's a little bit of a journey and an expedition to do all of that. And I think that would require taking a lot of time off from work, but that's kind of on my bucket list. So maybe in a few years I'll do something like that.
You mean you're not ready to get to do a quick takes from Botswana or Tanzania?
That would be an interesting one with maybe some of the animals in behind me. That would be a very interesting non-virtual background to have for a future episode of Quick Take. So maybe
Well, if anyone in the Kenyan tech ecosystem or the Botswana tech ecosystem is interested in having TechTO come visit,
we
just reach
will.
out to Alex, and we'll
Yep.
we'll gladly do talk about how tech is changing the world of safaris.
That would be very interesting. So yeah, let us know. I would love to volunteer myself for that. So thanks for that good call out. So next headline is the Canada Drives news. So their pivot obviously not panning out how they were hoping it would be. So what's the news? Why Did it end up in the ditch, so to speak? And what does this mean?
So Vancouver-based Canada Drives went into creditor protection in BC earlier this week. So first of all, we don't talk about creditor protection a lot. You hear in the States this thing called Chapter 11. It's very similar. It's basically when a business says, hey, we have a business here. We're actually insolvent, but we think there's something to be salvaged. So we want to get the court to protect our assets from our debtors. So you can't come and, try to take money out of the business, take assets. And we want to reorganize the business and come out with a new sustainable business.
Mm-hmm.
And so this protection protects them, so what basically Canada Drives is doing right now is they're going, hey, we're going to come with a new plan to go forward. We're going to be able to shed unprofitable contracts, get rid of employees, sell assets, and then negotiate new terms with creditors. In this case, creditors I think are TD, Amazon, and Google are some of the ones mentioned. And then once they have this plan, they go to the court and they have to say, they're the ultimate ones that say, okay, we approve this plan, you can go forward with it. The court also has to take into consideration that they believe that the majority of the creditors will support it. So the court can't just say, yeah, well, you're not going to have to pay TD back and you can pay Google back in 15 years. They have to have a plan that they think is viable and will allow them to pay TD back, or Google or Amazon Web Services in a reasonable time. They have to think that the TD Bank, Google, and Amazon will give approval to this.
Right. And so how did this happen for them? Like how would a company find themselves in this position?
Well, there's many ways, but let's talk
Yeah.
about this one in particular.
Yeah.
Canada Drives, actually, if you go back to like 2020, then the 2020 fiscal year for them, they had a very successful and profitable business. Their original business was basically generating and selling leads to car dealers. They look for people looking for financing. They'd be looking for new car purchase. They'd be looking for people looking to buy, for a car, and they sold the leads. They generated in the last fiscal year before COVID, $86 million in revenue and $10.5 million in operating profits. That's actually probably makes them one of the more successful tech companies at the time. That was still private. Then what happens? The pandemic happens. And I think Canada Drive saw a challenge and an opportunity there. The challenge, well, I'll start with the opportunity. The opportunity was over the last few years. Before at that point, you saw the emergence of a vertically integrated online used car dealer. Think of Carvana or Clutch. These companies said, you know what, we're going to generate leads, but we're also going to basically do the whole thing online. So we're not going to have a dealership physical place. You'll be able to come shop our online store. We'll drive the car to you and we'll sell to you, and we're going to make profit. We'll capture the margin in that whole process. We'll sell the car. Maybe you can make money from insurance. Maybe you might make money from finance. So there's opportunity. Those companies were highly valued. So I'm sure the Canada Drives execs said we're doing great, but those guys, they got millions of revenues. They got huge valuations. Second thing that happened, which probably forced them to act, was all of a sudden no one wanted to go into any physical goods store, and people were shopping more online, getting fulfilled online. So digital first was becoming the way. So Canada Drives looks around. They say, okay, time to pivot the business. We could go raise money because it was easy to raise money back then and become a digital dealer. The results were revenues grew really quickly, but they were now in a more complex business that was more capital intensive. But when they did, there was tailwinds. You grow fast, we're going to give you money. All car dealerships are going to die. Used cars were not easily available, so there was safety in the margins there that were historically high margins. But then over the last 12 to 18 months, what were tailwinds became headwinds. Used car prices fell, interest rates rose, and it was hard to raise money. So now Canada Drives wakes up and they don't have enough cash to go forward.
So it's good to understand, I guess, the process and what happened until now. So just have a better understanding of right now and the current situation. Like, what does this mean for inventory, their teams? Like how is this all, I guess, unfolding right now?
In the Globe and Mail, they reported that the company has 326 employees now. They had revenues in the last year of 298 million. That's a significant increase, but they went from a 10 million operating profit to a 80.5 million net loss. And how do they try to handle this? They try to raise $100 million in the fall. They secured 40 million of that, so they didn't successfully do that. They also try to sell the company. They apparently had an agreement that fell through, and so they were cash. They burned through their cash. They went for protection. As of the time they went for protection from the court documents, they have 1,200 cars. They have 8 delivery trucks, 63 trailers. just a lot of people, a lot of assets.
Yes. Yeah. So, I mean, what do they want to do, I guess, now?
So, you know, they want to almost reverse the pivot. Like from the
Right.
way what I'm reading, they want to say, okay, let's, this previous model was worked really nicely. It was very straightforward. It was asset light. We want to find a way to restructure business. I guess that probably includes selling the cars, the trucks, the
Yep.
trailers, getting rid of employees, paying down some debt after that, and paying some debt over time. But go back to basically matching selling leads.
Right. So, I mean, downsizing on all fronts for sure. Do you think this will work for them?
Look, I hope it works. Do I know it
Mhm.
work? I don't know. The world of online advertising, what's interesting is the whole model may not be working as well as it used to either, because a lot of companies, there's more competition for digital car buyers than there was before, because you do have these vertically integrated ones that still exist. You have other people have come up with new models to sell leads to dealers. Then you also have the changes in the ad market space, with the cost of acquisition going up across the board because of the moves Apple's taken. So you may have a model that's still profitable there, but you have new competitors, new dynamics, and
Mhm.
probably less of an arbitrage than you did before.
And just lastly, some additional takeaways for our community.
First of all, this is a reminder that not all pivots are successful.
Mhm.
They've been sort of glorified in the ecosystem over the last decade. We read about the companies that did one pivot, they changed the customer, they changed the business model, and saved them or made the company the big hit they are today. In this case, it took a successful company off a path and into a ditch. There's also another reminder here is that we hear about top line revenue, we hear about growth. There's lots of companies that look successful from the outside, but until a company's actually creating more value than the cap, or sorry, creating more value than it costs to create it, and being
Mhm.
a sustainable business, there's a company may be on the path, but there's no guaranteed success. Um, and then this is you know this is what also here is I think people underestimate the value of a simple business model. Like, look, I'm not saying simple beats complex,
Right.
but there's differences, right? A complex model, if you get everything right, there's more points of failure and more things that could sink a company. If you get it right, it's a huge moat versus a simple business model, which can be emulated much easier. But like, well, let's look at what happened here with Canada Drives. Um, the old model, they had to be best in class in acquiring leads, right? Because if they could acquire leads that convert better than everyone else, they can go sell them for a higher margin, and just basically let's buy low, sell high. Don't need many people. There's one thing you have to be best in class at. Now let's go to the vertically integrated model. What do they have to do to build value? They have to be understand demand. So they have to know what cars are going to be in demand and where and what price they could sell for. So that they project all that. Then they have to go acquire these cars and be great at acquiring them and then refurbishing them. So that knows what price to pay, what's the cost of refurbishing them, be able to do that cost effectively. Then they have to do logistics. They have to move the cars around. They have to do it. Then they have to acquire customers, which was their core strength before. They have to also price the cars better now. They also have to manage working capital because need a lot more capital. So any one of these, if you're significantly disadvantaged, you're going to have problems in getting good margins. So, and also this model required more people, more capital. Now, don't get me wrong. If you're best in class across that, it's a much more profitable market, probably has a much more enduring moat, but it's just a lot more complicated to execute against.
Right. I think those are great call outs too. Just as good learning, as we said, obviously this isn't positive news, but it's good learning for everyone, and things to definitely take into account. When
And
it comes to growth in your own business, right?
I look at it slightly different. They're still in the ring. If hopefully they can come out swinging. And we're talking about Canada Drives as being a leading
Yeah.
lead gen company for years to come.
Yeah. And I'm also like, I think that's a great place to end with that one. So, just lastly, before we finish, lots of raises and acquisitions for our lightning round that happened over the last couple of weeks. So, to start, Shiny Docs with that news. So, it's a news there, and why is this interesting?
So they're Kitchener-based. Shiny Docs announced that it raised 16.25 million,
Mhm.
led by Toronto-based First Ascent Ventures and Export Development Canada. So a couple of things to note here. Shiny Docs competes in the ability to find information for enterprises with their internal
Mhm.
documents. This is a really competitive market,
Yeah.
but they seem to be taking a position with lots of government and oil and gas customers. These are hard industries to sell. They take a long time, long sales cycle. So it appears that here's a way to position yourself in a very highly competitive market. If you can get a sub segment that provides sort of like your moat, there's an ability to raise money and build a business off.
Mm-hmm.
The other interesting note here is the investors First Ascent. They're Toronto based and focused on SaaS businesses. We don't see many deals by them. And then EDC, they invest in Canadian companies looking to export their software or focusing on export. So this means that probably Shiny Docs is going to be focusing on expanding outside of Canada.
Right. And you don't hear that many deals coming from them either. I can't remember the last one. Spark Microsystems news, and why is it interesting?
So Spark Microsystems raised 34 million in a round led by Idealist Capital.
Mm-hmm.
Spark's a fabless semiconductor company that claims its products can reduce power and offer higher throughput. So this is interesting. We talked about GaN Systems selling
We
last
did.
week.
Yep.
Also another fabless company. Also, one of the reasons they're successful is because they're energy efficient. So I just found this contradiction kind of interesting, because we talked a lot about how we don't have sort of a semiconductor strategy in this country. It's always semiconductors have always been a strength for this country. So yeah, maybe we're wrong. I'm wrong. Maybe organically we're so strong we don't need a strategy, but it is it's one of the strategic industries going forward in tech. So just interesting to see. One company gets sold, another raises money.
Mm-hmm. And some Vancouver-based news now. So Teleport, what's the news there, and why is this interesting?
They raised 2.5 million USD in a round led by AppWorks and Finance X. Teleport offers an infrastructure that connects blockchains. We did have a Web3 event yesterday, so
We did, yeah.
that's interesting. But this is interesting because it's actually reflects what I saw on the Web3 event yesterday. Web3 appears to be out of favor in the press and the media, but there's still funding out there. There's still people building infrastructure. If you and it's like a lot of big technology changes. Sometimes we have to keep them building till we find the right use cases. And as long as people are out there building, it portends a future where blockchain is essential or a part of overall technology. So, just a reminder that blockchain is still out there.
Yes. And one of the interesting takeaways from yesterday's event that I found is just the limitation around knowledge of how easily, I guess, integrated these things are and can be into our daily lives. So it was interesting to hear a lot of these founders yesterday talk about just how simple it is. Even with the PO apps, I found it very easy. And that was my first time ever using something like that. So that was very cool. So Happily Robotics, what's the news there and why is it interesting?
So they're Montreal based. They raised 3.5 USD from BDC's Deep Tech Venture Fund. They developed it's a product called the Inverse 3, which is a haptic interface designed to give feedback via controller. So basically, if you're interacting with something online, it gives you feedback. So it makes it more real. Again, like Web3, AR, VR, metaverse, robotics have been areas that people said are overhyped. They're not going to get financing. But here's an example of a company getting financing. I think we'll continue to make progress in technology there. I actually think, you're going to see a mix of robotics, AR, VR become more vital, because I think we have a long-term labor shortage issue.
Yes.
And so I think there's an area you're going to see more investments over the foreseeable future.
Right. Right. And lastly, just news from BlackBerry. So what's the news? And lastly, just why is it interesting?
So before I get to that, describe this. What do you think BlackBerry does?
I mean, I would assume they make phones, right? Like that was my first cell phone, for example, was a BlackBerry.
Yeah, it was one of my first. It was my first smartphone. So yeah, I think most 19 or 99 out of 19 out of 20 or 99 out of 100 Canadians will think BlackBerry is a phone maker. Well,
for phones, yeah.
This news is actually basically puts a nail in the coffin of its phone making days. So what the news was, Global Mail reported that BlackBerry sold most of its legacy smartphone patents for 170 million upfront, and a deal that could be worth up to 900 million. BlackBerry had previously tried to sell these patents for 600 million, and a deal that fell through. So this is interesting because this basically is a final nail in the coffin of the BlackBerry smartphone era.
Yeah.
It simplifies the business to focus on its IoT and cybersecurity businesses. So just interesting. Again, simplification is important. It also shows you how long a brand can be misidentified with what it does. And finally, it's interesting to see that, there's a lot of emphasis put on the value of patents by people outside technology and outside the venture community. And yes, patents are important and they're competitive advantage, but it shows you in technology how quickly they can lose their value, because this was assets, a year and a half ago, they were trying to sell for 600 million. They got 170 million. Like, look, the 900 million is probably a nice number for shareholders. Yeah. When I see a deal like this, like maybe they get to 200, 220, I don't think they get to 900.
Right. That's kind of sad news. It's like the door's fully closed now. I think I actually found my original BlackBerry the other day, and I was like, oh my God, I can't believe I actually had something like this. So we covered a lot. Just before we go, some events, just to call out that we have coming up for the community. Best of TechTO, which brings together a lot of these companies that have had just really unbelievable years and have a lot that they can bring, a lot of knowledge. We just tend to have a lot of programming around that.
For best of, I think we've got a great line of speakers. There's gonna be a lot of knowledge shared, and from people that have had a successful year. So it's a celebration of what's good's happened, and so it always excites me just to be in a good mood.
Right, and we also have a health TO coming up as well. We have an event in Montreal. Oh my gosh, I'm sure I'm missing many others that we have coming up, but everything obviously is available on our website, techto.org. And I'll link how you can get tickets and what's coming up in the show notes as well. Alex, thank you so much for helping us break it down. If you like today's episode, don't forget to like and subscribe wherever you're watching or listening. We will be back in 2 weeks' time with another episode of Quick Takes.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea. So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.